All right, I wanted to go over some of the transactions that happen with accounting. This is a little bit more complicated probably than what you had in the first chapter. So just want to do sort of an audio PowerPoint so you guys have an idea or maybe a better idea of kind of how this all goes down. Also, I have posted some other videos to help you as well. So go ahead and refer to those as maybe you go through this PowerPoint too. So we are going to basically look at a transaction, see what happens to the accounts, and kind of find out how to record those. And then once the time period has ended, whether it's the month, the quarter, or the year, we're going to figure out how to take all those transactions and sort of summarize them into what are called financial statements. So let's go ahead and kind of figure out how to do that. What I kind of tell my students is that accounting basically is going to tell you a story. So accounting is not necessarily all about math. It's kind of like learning another language, in my opinion. And what you're doing is you are figuring out what has happened in your business in any sort of time period. And by looking at the financial statements, you can tell what's happened. It tells you a story of what has happened with your sales, what has happened with your expenses, what has happened with your cash. So you are summarizing the story of your company into like 3 or 4 pages, basically, of financial statements. So when you're looking at a transaction, what I like to say is first, tell me what happened. So, for example, let's say that you sold a piece of equipment for $100. Well, what happened? Did your bank account go up $100? The equipment that you had that you sold, is that now out of your store? And then we need to talk about some of the costs involved in that. So transactions to be recorded when they need to be recorded, and we'll talk about basically when to record revenue, when to record those expenses. It may not be as simple as you as you think, unfortunately. How we're going to do that, and then the amount. Okay, all right. This is the accounting equation: assets equal liabilities plus equity. There is another video on D2L that explains what an asset is, what a liability is, and what's involved in equity. Let me just kind of give you a quick rundown, and then I'd like you to watch that video as well so you have a good idea. Assets, I like to say, in general, are kind of if you own a business and you had to liquidate tomorrow and skip town, let's say for some reason, an asset would be anything that you could sell for cash, and cash, obviously. A liability is anything that you owe. And then equity, stockholders' equity, is made up of a couple different things. It's made up of revenue, and revenue is what you earn by doing your job. That increases equity. Expenses are any debt that you may incur or pay because of your job, because of what your job is. Also, what's involved in that is any contributions that your owners of the company make to the business. So if you're starting up a business and one of the owners contributes some cash or some equipment, that increases the equity. And any sort of money that the owners may take out. So if you pay dividends to your owners, or if the owners decide to take some cash out because of some personal expenses they have, those are called dividends, and those decrease your equity. So that's kind of a quick way to figure out what transaction is involved in which category here. And there is more to it. And again, I would like you to view the other video to describe more in detail what an asset, a liability, and an equity is. Okay, so let's talk about the framework here. So let me see if I can make this a little bit bigger. There we go. All right. So we have the accounting equation, and then we are going to do some transactions within that equation. That equation must always balance. And then we're going to kind of summarize and figure out what we need to do. So In this case, we have our balance sheet, one of the financial statements, and we'll kind of go into that in a little bit. And then our transactions. So all of our transactions are going to affect at least one or two of our financial statements: balance sheet, income statement, statement of cash flows, and then there's a statement of retained earnings. Again, the accounting equation must be in balance. So the ending cash on a balance sheet must equal the ending cash on a cash flow statement, and we'll go into a little bit more of that later. And then income, net income on the income statement. Net income is the income that you're able to keep after your expenses have been paid, which it's different from revenue. Revenue is everything that you make. Net income is just what you get to take home after your expenses have been paid. Okay, so that is the net effect of revenue and expenses. So let's kind of go through the first transaction here. So Dr. Landry, I don't know, a doctor, is starting a practice and he invests $6,000 to start the practice. So essentially he's taking $6,000 out of his personal bank account and he's going to put it into the business account. One thing to keep in mind is we don't care what happens with his personal stuff. That's not what we're dealing with. We're only dealing with the business. So what happens to the business's bank account? It goes up by $6,000. Okay. Cash is an asset. If you had to liquidate tomorrow and skip town, that would be one of the things that you could take with you for cash. Okay. The other side of that, remember there has to be two sides at least to every transaction, is equity. The owner, Dr. Landry, has invested $6,000, so you're going to increase your equity by $6,000. So the equation balances. You have $6,000 on this side and $6,000 on this side. One increase in cash and one increase in equity. Okay. So the next transaction is that they borrow $10,000 from First National Bank. So let's talk about what happened. Your bank account went up by $10,000, but are you going to have to pay that back at some point? Yeah, you're going to have to pay that back at some point. So what assets or what accounts are we dealing with? We're dealing with cash, which is an asset. And then if you have to pay that back, that's going to be what's called a payable. Anything that has the word payable in it, you know is going to be a liability. It's a debt that you owe. So your cash, your asset, went up by $10,000, and your liability, your payable, went up by $10,000. So the equation still balances. You have $10,000 that went up on the asset side, $10,000 that went up on the liability side. Let's take another look. They buy land for $12,000 in cash. So let's talk about what accounts we're using here. You paid $12,000. Your bank account just went down by $12,000. And what did you get for that $12,000? You got a piece of land. And land is an asset. If you had to skip town tomorrow, theoretically, you could sell that land for cash. So your cash went down by $12,000, but your land went up by $12,000. They're both assets and they have just canceled each other out, so that equation still balances. The next one is they earned a fee of $5,500 and they received them in cash. So again, let's talk about what happened. Did your bank account go up? Your bank account, in fact, did go up by $5,500. So cash, which is an asset, went up by $5,500. What did you do for that cash? You did your job. So you're earning money for your job is revenue, and revenue increases equity. So we have an increase on the asset side, and then we have an increase on the other side, or the equity side. So this still balances. Let's take a look at the next one. They paid $2,900 in cash for various expenses. And I kind of wish they had broken this out into what those expenses were, but that's okay. We'll just kind of move on. So let's talk about what happened. What happened to your bank account? Your bank account went down $2,900. Bank account or cash is an asset, so your asset decreased by $2,900. What did you pay for? You paid for expenses. So expenses falls under that equity umbrella and it decreases equity. So you're going to go down on your asset side and you're going to go down on your equity side so that the accounting equation still balances. Oh, and I guess this is the breakdown: the wages, the rent, the utilities, the interest, and miscellaneous. Okay. All right. Excuse me. The next one is that they paid dividends of $1,500 to their only stockholder, Dr. Landry. Essentially, what this is saying is Dr. Landry took $1,500 out to, I don't know, take his family on vacation or whatever. So let's talk about what happened to your bank account. Your bank account went down. So your assets went down, and it's a dividend, which goes under that equity umbrella. And that equity umbrella just went down, excuse me, by $1,500. So again, the equation still balances. All right. So let's just say that that was a month's worth of transactions and you want your financial statements for the month. Well, you've had all these transactions. And what you need to do with all those is you need to keep track of what's in each account. The whole reason that we record all this stuff is so that we have an accurate balance in each account. So I think every single transaction that we did involved cash. So we added cash here, we subtracted cash here based on what happened. So at the end of the month, we have a balance of $5,100. We only had one land transaction, and then we had one liability and then a couple of equity. We had one in the contributions, the stockholder when he made that initial contribution, and then some expenses that were involved, some revenue that's involved, and then some dividends that were paid. So we have a balance in each account. What we can now do with that information is go ahead and put in our financial statements. So I think that it's going to go into more detail. So let's go ahead and just kind of skip over some of this stuff. Well, we'll go over that later. We don't need to go over that now. So the first thing that you're going to want to do when you're doing financial statements is the income statement. You must do the income statement first because you're going to need that net income number to do the rest of your financial statements. So again, if you go back to the other videos and look at what accounts are in each financial statement, I think that will clear it up a little bit. But your income statement is a statement of, guess what, your income and expenses. That's it. So you're going to take what you earned in revenue or income and subtract out all the expenses that you had to pay. And in this case, we came up with a net income of $2,600. The next one that you're going to want to do, and I'm surprised they don't show it here, is a statement of owner's equity. So essentially what you're going to do is you're going to take that $6,000 that he contributed, which increases equity, and then you're going to take your net income, which increases equity, and then you're going to subtract out that $1,500 that he had in dividends. And that's your ending balance for equity. Well, then you're going to move on to the balance sheet. And your balance sheet is exactly like this: your assets, your liabilities, and then that ending equity balance. And guess what? Your assets must equal your liabilities plus your equity. So you have your balance of your cash and your land, which are your only assets. And then you have your liability, that's your only liability. And then the conglomeration of what happened with your equity between your income, your expenses, your owner's contribution, and your dividends here. And these three numbers equal these two numbers over here. All right, so here's kind of the breakdown of the income statement. And then you have your statement of retained earnings. I'm glad that they added that in. And then finally, your balance sheet. I'm not going to worry about cash flow statement right now. That is a difficult statement to do, and we're not going to deal with that, okay? Basically, this is kind of the other transactions that go with it. I'd like you to watch the PowerPoint separately so that you kind of get an idea of some of the other statements. But again, don't worry about the cash flow statement. It's kind of complicated, and I don't want to confuse you anymore than you might be with all the other stuff that's being thrown at you in this chapter. So go ahead and do this a couple times over, get used to it, watch the other videos, and do some problems.